Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday, January the 31st, 2020. Guess what? The month is over. Time flies when you're having fun in housing, I guess. Things are going at a good clip, and we'll see what's going to happen for the whole rest of the year. I think a lot of stuff's going to change this year. Major news today really is the December pending home sales. We'll talk about that in a second. But first of all, if you've inquired about properties, buying investment properties in my area, buying and selling homes, real estate investment training, whatever, I'm reaching out to a lot of people. I'm back on the track on that. I know some of you have responded, which is great. Please send me an email directly, put in your phone number so I can text you and I can give you a call and we can hook up and we can discuss opportunities that you'd like to pursue in the housing real estate marketplace. Oh, and by the way, if you're not already a subscriber, please help my channel grow and click the subscribe button at the bottom right of the video. I would appreciate that. Thank you. All right, today, December pending home sales fall 4.9% as supply hits a record low. Let's talk about this with some other headlines. We'll see how the headlines go here. U.S. pending home sales suffer worst December collapse on record. Number of buyers who signed contracts on homes plummeted in December despite high demand. Now, I don't make this up. These are things I'm pulling off the internet and the news. Although some of you think I'm biased in my discussions here, I'm actually not biased. I'm reading what's out on the internet. You can look for it yourself. All right. So the whole point here is that December, it's I guess you could say this is the pending home sales index. It's an index created by NAR, National Association of Realtors. They manage this. They take a look at all the homes that went pending in the MLS across the board nationally, and they basically say that it dropped 4.9% in December of 2019 compared with November 2019. So there was a decrease there. And why I guess the headlines are looking a bit ominous is because the projection was to actually go up by 1%. So it didn't go up, but it actually dropped by almost 5%. So you have an almost 6% swing there. So now December is historically a slow month. We all know that. I mean, I know that from firsthand dealing with clients. We know that not many people actually want to, I guess you could say, go out and find homes. They're busy getting preparation for the holidays, coming and going, traveling, whatever that may be. So December, it just isn't a great month for real estate as an average as a whole. But again, the issue was, it was supposed to go up by 1%. Why? Because of lower rates, and stimulating the marketplace. Home builders doing more stuff these days, but didn't actually come out with respect to pending contracts that actually dropped. So there you go. I guess you could say when you take a look at regionally how that was affected, the Northeast slipped 4%. The Midwest dropped 3.6%. The South decreased 5.5%, and the West fell 5.4%. So it was basically, that's that average out to 4.9% across the board. And you can see that different locations had, similar, I guess you should say, drops in activity. However, December crash, pending home sales still surged 6.8% year over year, with mortgages rates down over 1%, but fell to the lowest level since February 2019. So, it's fun how when you read these articles, how the headline says U.S. pending home sales suffer worst collapse on record, yet when you take a look at in the article, it still says pending home sales surged year over year. So we're looking at, they collapsed monthly, they surged on a year-over-year basis. So it's all about, I guess, who writes it and how they want to put the spin on it. And again, the article I'm looking at here is actually one of my places I go to for a lot of interesting articles. So just the way it goes. I guess you could say what happened. Well, contracts were down. Now, realize that pending home sales are contracts. So it's not sales. It means that homes went under contract. So if your home is actively listed for sale in the multiple listing service, the MLS, it's active. The minute it goes to a pending status, that means there's a contract that was placed on the property by a buyer that was accepted by the seller, so they're under contract, and that will be a future closing. That future closing could be 30 days, 60 days, 90 days down the road. That's going to reflect a future sale. So I guess, so you can extrapolate this looking forward, saying, well, if we didn't have a great month in December as far as expectations for contract signings, then that's going to be reflective on sales 2 to 3 months down the road. So please keep that in mind. Now, I guess you could say, funny enough here, it says the drop in contract signings in December suggests that the existing home sales reports coming out in the near future won't likely feature notable increases, which I just mentioned. Well, the drop in mortgage rates in the summer of 2019 provided a momentary lift for the housing market. It improved affordability for many buyers. The housing industry will struggle in 2020 with a depleted supply of homes for sale. Many real estate experts expect this will curtail sales activity in the next year. So once again, 2020 will depend on whether the home builders bring more affordable homes to the market, says Lawrence Yun, chief economist for National Association of Realtors. Home prices and even rents are increasing too rapidly, and more inventory would help correct the problems and slow price gains. Yes, it would. So we'll see how that pans out as the year goes on. Now, interesting enough, we've had home ownership rates rise to a 6-year high. So the U.S. home ownership rates hit another 6-year high. The Census Department put this report out on Thursday. Basically, home ownership rate hasn't been this high since the third quarter of 2013. The all-time high of home ownership was in the end of 2004 at 69.2%. It went down to 62.9%. We're now up to 65.1% home ownership rate right now. So I guess what that does, that's an indication as to more people buying and staying in their homes, because going along with home ownership rate, we also have home tenure. So tenure obviously is the amount of time in your property, and they typically take a look at sales, saying every sort of quarter that home tenure is actually increasing. So people are staying in their homes longer and taking longer to sell. There could be many reasons for that, but it's at an all-time high as well too. So it kind of runs parallel with home ownership rates. So having said that, let's take a look at the top 20 U.S. metro home seller gains in 2019. So Adam Data Solutions, they're a company that produces a lot of information out there in the housing market. They basically took a look at the home sales across the top 20 metros across the U.S. for 2019, and they calculated what the profitability was. So essentially, their 2019 year-end U.S. home sales report reveals that home sellers nationwide in 2019 realized a home price gain of $65,500 on a typical sale. Now, this number was up from $58,100 for 2018 and up from $50,027 from 2017. So we can see that we had a pretty good increase from 2017-18 to 2019. So if you sold your home in 2019, you averaged out at $65,500. All right, so let's take a look at each individual 20 of the marketplaces here. So this is just in alphabetical order, and I'll give you the percentage points as far as what you bought for, the average, and what you sold for, that average gross profit percentage spread, and we'll do some numbers as well too. So Atlanta came in at just over 30% gain. Boston area, 48% gain. Charlotte, North Carolina, about 28% gain. Chicago area, just under 20% gain. Cleveland, a 19% gain. Dallas-Fort Worth area, about a 42.5% gain. Denver area, almost 47% gain. Las Vegas, 45% gain. LA area, 54% gain. Miami, Fort Lauderdale, almost 46%. Minneapolis, St. Paul, 32%. New York, New Jersey, Jersey City, 31% gain. Phoenix, Mesa, Scottsdale, Arizona, almost 37% gain. Portland, Vancouver, Hillsborough in Oregon, Washington area, 54% gain. San Diego, almost 46% gain. San Francisco, Oakland, Hayward, California, 72.8% gain. That's your number 1% gain of the top 20 metros right here. Seattle, Tacoma, Bellevue, Washington, 65.6. Tampa, St. Petersburg, Clearwater, where I live, 38.2. And Washington, Arlington, and Alexandria, Virginia area, the DC area, 21.4%. So really, as far as a percentage is concerned, your top locations are all West Coast, with San Fran being number 1. You've got Seattle area number 2, and Portland, Vancouver, and LA being tied for third at 54.1%. That's on a percentage base. If we take a look at pure dollar value gross profit, and I will post this link in the description section of the video so you can take a look at it for yourself. So San Francisco leads the way with $366,500 gross profit from a sale if you sold in 2019, followed by LA, $225,000 and change, and the next one is Seattle at $184,000. And we got actually Boston next at $139,000. So, excuse me, guys. So, well, actually, no, yeah, Seattle, 184 was Seattle. San Diego was 179. There you go. So typically, again, where we're seeing the most gross profitability is where we're seeing the most percentage points of profitability as well too, and they just happen to be what? West Coast locations. That's the way she goes, guys. So that's what's happening out there. So if you sold your property in California last year, you probably did okay as far as I'm concerned. So having said that, let's talk about mortgage rates right now. Mortgage rates fall to the second lowest level in 3 years. The average U.S. fixed rate for a 30-year mortgage declines to 3.51%. So Freddie Mac does a primary mortgage market survey and basically saying this week's mortgage rates were the second lowest in the past 3 years, supporting home buyer demand and leading to higher refinancing activity. Of course it does. So basically, this time the pace is now 95 basis points below this time last year's rate. So last year, the average rate was 4.46%. It's 3.51% now. So clearly we see, that's almost a full point below what was going on last year, stimulating a lot of home sales and a lot of activity in the marketplace. So when you have lower rates, what happens? You have applications. So weekly mortgage applications surge over 7% as rates happen to fall. So mortgage rates fell to the lowest level since November, and that sent current homeowners and potential buyers rushing to their lenders. So we're all rushing to get to our lenders and get ourselves an application pre-approved to go buy a property or to refinance. So clearly, applications to refinance a home loan, which are the most sensitive to big interest rate swings, increased 8% for the week. That's 8% from the previous week to this week, and we're 146% higher than this time a year ago. So when I just mentioned the rates going from 4.46 to 3.51 on average, almost a full point swing. It's a big number for a lot of people. It makes a big difference in refinancing. So clearly you're going to see that market picking up. We know that through 2019, especially the latter half of 2019, we've seen a lot of refinance activity, applications and activities going on. To me, again, that means people that are refinancing are probably not putting their homes for sale in the marketplace, which maybe hurts our inventory and our sales ability going forward. Mortgage applications to purchase a home increased 5% for the week to week, and were a strong 17% higher than 1 year ago. So clearly, at 4.51%, people weren't, or actually 4.46%, people weren't jumping for joy about putting an application in for a home purchase. Now it's almost a point below. There's more interest there as well too. But again, you can still see the difference in the refinancing applications and the volume versus the home purchase volume. Okay, mortgage applications continue their strong start of the year as borrowers acted on the drop in mortgage rates last week, said an MBA Mortgage Bankers Association economist. Rates were driven lower by investors' increased concern about the economic impact from China's coronavirus outbreak, in addition to existing concerns over trade and other geopolitical risks. Now, on this channel, I don't really get too involved in politics of housing, even though that will be picking up this year. More of the candidates will talk about housing and homelessness, I'm sure, as part of their platform going forward to the election. As far as trade wars and other issues, clearly, as investors, get rattled and consumers lose confidence, dropping rates tends to sort of, solve some of those issues and bolsters the economy. So now the Fed actually just came out this past week saying that they're not going to reduce rates this time around. They're going to leave things status quo. So that was an announcement from the Fed, and so that didn't really have an impact on rates. But the other extraneous things like the coronavirus and trade and tariff wars are pushing the confidence level down. Therefore, we have lower rates. So there you go. That's how it all works together. Now, it's a little funny article here. I had to laugh when I saw it. So Fannie Mae issues warnings to lenders about mortgages and things like that. So I guess back in 2018, Fannie Mae issued a warning to lenders after identifying more than 30 fake companies that were appearing on borrowers' mortgage applications. So what this really is you're saying you have a job and you're working at this company and you're making X number of dollars a year, but guess what? It's a fake company. And apparently there was 30 companies on this list. Then it grew to 15, so it was at 45, and now it's pumped up again. So we're taking a look at the list of fake companies, grows to 65 companies now that are appearing on mortgage applications. So what does this is mortgage fraud. So this means that people are trying to get properties or they're trying to refi, and they're stretching the information, the truth, making stuff up, trying to get approved for a mortgage. Now, this is on the applications. Clearly, when you actually go to a closing and they're doing the mortgage, they're preparing the mortgage, they're going through all the stipulations, you're going to have to provide letters of employment and W-2 information, things like that. So a lot of this would come out in the wash. But the point, though, is that we see mortgage fraud increase when two things happen. We have lower interest rates, which we do now, and second, we have higher appreciation. So we've basically bubbled up as far as I'm concerned. In a lot of locations that we've talked about, we've seen the appreciation is there. Like it's peaked, and it's actually decelerating appreciation, which we've spoken about in previous videos. Some locations are starting to erode. So we see that when things are going up or at the top, more people jump out of the woodwork to get in on the real estate game, to get a piece of the action, to try to make money. And so there's fraudulent activity in that respect. There's fraudulent activity in the use of the home. So you may be applying for a mortgage and saying, well, I'm going to use the home as a primary residence. Why? I'm going to get a better interest rate. And my loan to value is much greater, so I bring less to the table at closing, but you really want to use it as an investment property. So all these little fraud things sort of, kick out with respect to markets being where they were. It happened back in the last housing boom and crisis. It's happening again right now. Just keep that in mind. It's food for thought. All right, guys, that's it for today. So not a heck of a lot going on, but I thought I'd just tie it up with some interesting news. So a lot of the world these days, a lot of housing is really rate sensitive. So we're seeing more and more as time goes on because of high prices. Your buying power increases with lower interest rates. Now, again, you're not buying it cheaper. You're just buying it better, and maybe you can afford more based on a lower interest rate. So having said that, guys, I appreciate all the likes, views, and comments. Please share the video with your friends and family if you can. If you're not already a subscriber, please hit the subscribe button in the bottom right. Help my channel grow, and I really appreciate that. And if you haven't hooked up with me yet to talk about buying a home, selling a home in the area here, real estate investment opportunities, I'm getting more and more opportunities every day that are coming across my desk. If you want more information on real estate training, advanced short sales, trying to buy distressed properties, trying to make money, and you can in this high expensive marketplace, drop me a line, send me an email. Please include your telephone number, so I can text you and give you a call, and we can talk about what's going on and what you need, what you want to do in real estate. For those of you that have reached out, I appreciate it. I'm following up with a lot more people these days, and we're trying to get stuff happening. So again, thank you and for the views today, and we'll look forward to speaking with you early next week.